Nothing's worse than when I don't have it on. Okay, so guys, we are going to start with chapter 2. Now, I will tell you that there is a lot in this chapter we will not be covering. And so there, just know, some important stuff, but a lot we won't be covering. So we're going to, again, key in on the key concepts. And so when we're done with chapters 1 and 2, I will have available starting next Friday for a week the chapter 1 and 2 quiz. And I don't have it created yet because they're importing my test bank from the publisher site. But generally I like to do 10 to 15 multiple choice. And if there's matching, I love matching because it's an easy way for you to simulate the responses to the certain terms. And then usually one discussion of some type, okay? So definitely I try to keep them simple because you don't want to be doing tests all weekend. But that will be, there will never be a date you can't take it, but I have a close date, okay? So starting with chapter 2, we're going to get into a little more detail about FASB's framework and basically talk of some key elements I want to pay attention to as it relates to financial reporting. So the intent of this framework is to establish a guideline or foundation of objectives, concepts, and definition that leads to the establishment of consistent, high-quality financial accounting standards in accounting practice and applying those standards in practice. So ultimately, FASB is created to provide guidelines that ultimately provide financial statements with the most concise and clear and relevant information that people can use on a consistent basis. Basically, this framework establishes accounting standards and helps people understand how the financial statements need to be prepared. If there's an event where there might not be a specific standard that applies to a specific situation. And then from there, how to create informed judgments and ultimately create sound financial statements so the public can trust those financial statements. Now, accounting principles. This is what I really want to focus on. These are theories, truths, and propositions that serve as the foundation for accounting and financial reporting. Most of them come from FASB's Statement of Financial Accounting Concepts. They're known as concept statements. Now, they mainly establish the principles, the fundamental basic principles of accounting, what the purposes are of reporting, financially preparing reports, what consists of qualities that make information useful, and then definitions of terms we use a lot, and then really understanding economic transactions and events and how we are to report those on the financial statements. Guys, a lot of what you learned in Principles 1 and 2, these were concepts. And these concepts are created so when we come up with various business transactions, we know how to analyze them, how to report them, okay, and how to value them. Do you understand what I'm trying to say? Each business transaction, we go through a process of analyzing, do we need to do something with this? In addition, they give us information as to how we measure various transactions and how we classify them in the financial statements. That's ultimately what this whole concept of accounting principles and the FASB concept stands for. For example, we understand there are certain transactions that need to be reported because they're economic events, because we record economic events. And there are certain economic transactions we might not report, right? Such as, Justin, I like you so much, I think I'm going to hire you. That's an exchange. If I had a business, is there anything I'd need to record? No. What if I said, Justin, I really want you to come work for me in 6 months. Here's a $3,000 check for a bonus to hold you for coming to work for me. Is that an economic event? What would I record?
$3,000.
Bonus. What date would I record it on? The date issued. How much would I record?
$3,000.
What would I put it as?
Probably personnel expense of some variety.
Do you see how really these concepts have helped us to determine how we analyze and report and record transactions? So the goal is for better financial visibility, financial standard reporting, so users can trust it. Now, there are accounting standards that help provide information on how companies should account for and report transactions, events, and arrangements in their financial statements. There are standards in GAAP that help us know how to measure things, and we've got some rules. Basically here, I'm not going to even mess with that. We've got concepts, we've got standards. Ultimately, it's to develop procedures and methods for good financial reporting. And this just shows how the connect comes together, but don't worry about it because I'm not going to ask you about it. We are not going to talk about the framework or the history, okay? You can read that on your own and give us some insight. But we do have frameworks, okay? Ultimately, financial reporting, and this is important. This is what I want to focus on in this chapter. Financial information needs to be useful in decision making. It should provide useful information about the entity so it can provide guidance for new investors or existing investors or creditors, lenders, or other people. It needs to be useful to external users in helping them assess expected returns. Now, what does that mean, assess expected returns? Information needs of investors, lenders, and others to help provide suppliers of money because they want to see how the cash flows are going to happen. They're going to want to see what the returns might be as a result of needing to possibly free up money. And then external users need information to form expectations about the timing and amount of cash receipts and assess the risk involved. So ultimately, when a company has an investment when a person has an investment in a company, they want to see, what's my return going to be? When could I possibly see some money? They need to have answers to help take care of their own financial situation, okay? It needs information, helps in assessing the company's cash flow. It helps them see the cash flow again, the ability to generate it, and it also helps them see the assets and the liabilities on a company, the resources, the obligations, how much equity is in the company, and then the changes in the company's resource and claims. Those aspects know in general the importance of why we have guidelines in place. Now, I'm just going to highlight on accrual accounting. This measures and reports economic effects of transactions. They use the word events and circumstances. Well, because an event can be a fire. A transaction is an exchange. An event sometimes can be a non-exchange, which means we both shake hands, I give you a service, you give me money. An event can be a fire. An event can be a theft. See what I'm saying? An event can be a hurricane. And then there's sometimes circumstances in a company where because of that circumstance, let's say legislation changed to where in the state of, you're operating a business in the state of Denver growing pot, and legislation changed that now it is illegal. Due to those circumstances that have changed, we need to report how that has affected you on your financial position, okay? Now, if I'm a CPA in Denver, that might not affect me, but that legislation may affect someone else, okay? So accrual accounting measures and reports those economic results of transactions, events, and circumstances on a company's resources and claims in the period in which those effects occurred. It provides a basis for better assessing the company's past and future performance than just dealing with cash in, cash out, okay? Because when we just go on the cash basis of accounting, we're really not also matching the related revenues to those expenses that were incurred to create the revenues. So accrual basis really helps a company in the true manner see what really was earned and incurred in the period. Also, cash flows, knowing what was used, in what capacity, and how they were used, the ability to actually pay their bills and give money. Okay, we're not going to worry about that. There are certain ratios we're going to talk about in this class. We're going to just highlight it today, but we're going to talk about how certain ratios help companies or individuals, stakeholders, understand how much money they have invested and what return they're getting on that money they have invested. Sometimes we'll have various liquidity ratios in order to determine what their assets, their quick or current assets are in relation to their liabilities. So all of these different ratios help us in some ways to compare one company to another and gain a better understanding if we really want to invest in that company or continue or pull out. So mainly return on investment. Of course, risk is always a going concern in our economy because potential risk means potential doors close. And financial flexibility also is an important thing, especially in this growing economy, how companies need to be adaptable to change with the times. Can any of you think of a company that's just kind of going out of business because they haven't gotten with the times?
Best Buy is fighting to hang on.
Why?
Because times changed around them and what they sell and how they sell it.
How they
No
sell it.
longer as relevant as it used to be.
Is it what they sell or how they sell it?
Mostly how they sell it.
Okay.
But there is a piece of what they sell.
That is affecting them. Best Buy is struggling, aren't they? You gotta be innovative to stay current with the times because you do, you're gonna go under. Copy machines.
Xerox was also hanging on, but now they're making a comeback.
how are they making a comeback? What are they doing
They're
different?
pretty much restructuring. They're trying to get out of that, like, the end consumer and trying to focus business to business.
Good.
Strategizing, because they realize that they can't make as much as they used to by selling their, small printers and people just using their phones and having access to the information that they used to.
See, and that's the thing. Technology has changed so much that I hardly print anymore. Everything we do is scanning and saving it into
Pull
a.
out their phone, so
Exactly. So we have to evolve and merge with the times. So what's the flexibility to adjust and change?
Well,
Yes.
I work for Staples, and they are in no danger of going under, and yet we are still going through a huge restructuring, for lack of a better term, because storefronts are no longer viable. And they've already got a strong online presence, so they are now shifting more and more to that.
Well-
Much more of an Amazon type model, even though we still got some storefronts, and they still do some of what they used to. The entire business is shifting.
And it's hard to compete with an Amazon when you've got storefronts because it costs a lot of money. You know?
One thing that's sort of tied in that you would probably aware is the U.S. Post Office is struggling, and then there are unions that really are not happy about Staples potentially doing some things that the post office should be doing in their union labor through that, so, that's kind of funny.
Well, and I teach at, I teach at a place where there is a union. And times are changing within higher ed. And higher ed, you can't just have a Monday through Thursday, 9 to 10 o'clock class, which is what we have at a certain location. You need to learn to be flexible and offer night classes, offer hybrids, and sometimes some of these various schools may need to merge, the public system might need to merge in order to become more attractive and deal with our costs. And it is so tough for people who have been in the system for 30 years to change with it. No, online is not the answer. Well, hello, you don't get to decide that, because guess what? It already has become. Do you get what I'm saying? So it's interesting to see how things, flexibility is so important in all walks of life. Everything's changing all the time. So we need different types of information. What qualities make information useful? So to make information useful, they need to have qualitative characteristics and enhancing qualitative characteristics. They need to have substance, information that provides substance to them. Qualitative characteristics guide setters and financial statement preparers when choosing among accounting alternatives. What's useful information and what's not useful information. You need information that's going to change the mind of decision makers, okay? It needs to have quality, substance to it. Qualitative characteristics have relevance and have what's called faithful representative. They have everything in there. They're not missing a couple transactions. They have the whole shebang of all the information within that transaction period. They're free from judgment. They're neutral, meaning they're not swayed because someone's trying to bolster up the profits. And when we show that a check was written for $35.24, it doesn't show up on the financial statements as $354.20, okay? So it really needs to be representative of the truth, and it needs to be relevant. Now, the best way in this for me to say it is to read it in the book. Relevance is accounting information is relevant if it is capable of making a difference in decisions made by the financial statement users. Information can make a difference if it helps users predict future outcomes or confirm or correct prior expectations, and if it's material in nature and amount. So basically, it needs to give you information that will help you make a decision, help you use judgments to see how's this company going to flow, or can I trust the information from the past? So information is relevant when a user can take it and make decisions based on it. Okay? Those are the two key things I want you to understand. Relevance and faithful representative are qualitative characteristics that are key. Then, those are important. But on top of that, then, these others are nice. It's nice to be able to compare them. It's nice to make sure that the numbers can be verified and timely and we can understand them. But the two key focuses of characteristics that provide useful information is relevance and faithful representation. Okay. Relevance. Information that is capable of making a difference in decisions made by financial statement users. So that's the key. Relevance is what I want you to focus on there. Faithful representation, when the words and numbers really are the economic substance of what they purport to represent. So if the check says 100, the financial statement's reported as 100, not $1. And it provides everything you need. All transactions are included. Any information, all events are reported. Any disclosures that need to happen for you to understand are stated. And it's not slanted in its presentation. It's not manipulated to make the company look better than they really are. It allows the financial statements to be as they are. Okay, what's the relationship between being relevant and having faithful representation? That's how accounting information is most helpful, and they both should be utilized. So people can make decisions based on it. So how do you go about making these applying these characteristics? Let's look at this. We're going to identify an economic transaction, event, or arrangement that needs to be recognized in the financial statements. We're going to identify the type of information about that phenomenon that would be most relevant, material, and capable of making a difference. And we're going to determine whether that information can be faithfully represented in a manner that's complete, neutral, and free from error. Determine whether the benefits of that information are likely to exceed the cost. What are the possible outcomes? So basically, the key here is when we record transactions, we want to record, and most of the transactions we are going to deal with are going to be pretty straightforward. But what happens when we start dealing with trading equipment from another company, and we cannot calculate any type of fair market value on that equipment? Do you understand what I'm trying to get at? A lot of times we're dealing with checks and a bill. But what happens when we start getting creative or complex transactions, when we're dealing with assets or property that we're trading, where we really can't determine what is a fair value? And we go through the processes that the concepts will allow us to go through, and it still isn't clear. Okay? So that's where sometimes we have to use our judgment, but the goal is, have we represented that transaction fairly? Has it been neutral? And is it free from errors? So most of what we've done in these first principles 1 and 2, we haven't had to make a lot of judgments. But as you get into this intermediate accounting and then advanced, there's a lot of judgment calls because we're not always dealing with that monetary value that we can pinpoint. And we've got to find other ways of constructing or coming up with how we record a transaction. Did anyone raise their hand? Yeah.
I was going to raise my hand. Back to your example of like paying a bonus to hold an employee potentially down the road. Having all the information on that employee could help somebody make a decision about whether they're going to bring value to the company, but it's not going to exceed the cost of listing all of that, correct? That would be why that piece would be left off. Because if you were saying, I'm paying $3,000 to hold a brand new college graduate versus I'm paying $3,000 to hire a new CPA, that would make a difference to a decision maker potentially. But the cost of going through all that doesn't outweigh the benefit.
And, okay, basically, I think what they're trying to say is, as far as cost versus benefit, when we're dealing with verifying certain data, such as, let's just say, when you're doing auditing, to make sure that the financial statements are clean, are free from material misstatement, we would love to be able to audit and look at every single transaction and every single receipt, and then we can say, hey, we feel good. But can we afford to do that? So sometimes we have to use statistical measures to determine what amount of work or research do we need to do to say that they are fairly presented accordingly. So it's where the cost cannot exceed the benefit, we're dealing with more how much energy and effort and work do we put in. For example, Augsburg is trading this building for, say, a 100-year-old building of the U of M. And there are and it's a trade where there's no dollars involved, it's a trade of asset to asset. There are various guidelines we can go through in order to determine what we show the value and the trade to be, a gain or a loss. But to what extent do we spend time to calculate the numbers so specifically? We want to do our due professional care to make sure that we have a sound decision on those figures. But do we spend 52 weeks to determine that? One person's salary? Do you understand what I'm saying? The cost would not exceed the benefit of the report. So that's more what they're talking about in this scenario. These are characteristics that can enhance NOAM, but I'm not going to get caught up into them. We need to be able to compare business to business. They need to have the same methods applied time and time again. If you start with a certain type of depreciation, you need to stay with that depreciation. Or if you start with a certain type of inventory costing, you need to stay with that. And can we verify that the information that's being presented is in fact accurate? It needs, guys, what good is a financial statement that's 3 years late? There is some benefit to get the information in a timely manner. So timeliness is definitely helpful. And to be able to understand what's being presented on the financial statement so we can get the drift of what they're trying to say to us. Okay, now we're going to talk about principles in accounting. And assumptions are principles, and you guys have seen this before, but you will see this one again. There are guidelines that we do in reporting. The first one is each business is a separate entity from its owners, okay? Or it's a separate economic entity, which means when Shoemake CPA creates transactions, I don't show Jim and Nancy's transactions of Jim buying DVDs. That's the personal side of Nancy and Jim. Shoemake CPA shows expenses as it relates to the business only. The two are separated. Going concern assumption means all businesses are created with the expectation that they will continue on, that it's not shutting down in a month, okay? All businesses are created with the understanding they're going to continue on. And we record financial statements based on a period of time. We don't have a financial statement that says from 2000 to 2010, 3M made X amount of dollars. Don't we have an understanding that time is handled in weeks, months, quarters, and years? That is the period of time assumption. Monetary unit assumption. Are we dealing in rubles here? Are we dealing in euros? I was trying to think of something clever. Well, I was trying to think of like something we all want, but in vodka liters? No, we're not dealing in vodka liters. We're dealing in the US dollar. So we are in the assumption that we use money to be the value we place on items. Now, we also can compare our US dollar with the yen and the euro by learning about currency exchanges. But these assumptions, the reporting, going concern, period of time, monetary unit, basically those are the keys of the assumptions we learned in principles as to in recording transactions and setting up a business. These are focal. And I don't understand what they're saying by mixed attribute model. Let me just see what they're trying to say. Basically, what they're trying to say is you don't just create a balance sheet. You just don't create a financial statement. You need the combination to really accurately present the condition. While the balance sheet really helps us understand and time, the income statement really helps to understand the operations of revenues and profitability. And the cash flow helps us really understand how they use their cash. And so having the combination or the combined financial statements consolidated is most useful. And then assumptions as to when do we recognize revenue, or when do we recognize recording transactions? Generally, we have, for example, with recognition, if I'm going to do someone's tax return, can I go ahead and record it now? No. When can I record the completion of a tax return? And when the tax return is completed and I can reasonably assess the amount, you know, there are guidelines in place to know when we can recognize revenue. And then accrual accounting, we talked about how accrual accounting is record revenue when it is earned and expenses when they have incurred. Conservatism is always using a mindful approach of making our numbers realistic. So know about the legally separate entity. Know about going concern. The assumption is the company will continue to operate in the foreseeable future. The period time consumption is that we create annual or quarterly or monthly reports. Know about the monetary concept. Our national currency is the unit we use. The mixed attribute model, we're measuring assets, liabilities, revenues, expenses, and all the other financial statements to get the best relevant, reliable data. Okay, then no. Recognition is the process of formally recording and reporting an item in the financial statements. And accrual, we know about that. And so this is it, I promise. This is it, the last couple principles here. The revenue recognition principle, you will see this again, determines the appropriate period in which a company creates economic benefits and can recognize the revenues as income. The expense recognition principle determines the appropriate period in which a company has consumed economic resources in conducting operations. And then we have this matching principle where we try to match the expenses to the period in which we obtained this economic benefit that we got to use. Conservatism is avoiding overstating assets or income when you don't know for sure. You better have lower assets or lower income if you're not sure. It's a practical approach to avoid misleading investors. Guys, doesn't it make sense? Prudence is a better name. So, basically, we've got, this shows in a nutshell the makeup of the entire accounting information. We've got specific financial statements. Then we've got, with those specific financial statements, our notes and disclosures, which are our basic statements. Then we've got some extra information that we need to disclose as it relates to changes in concepts that are FASB standards. Then we might have this letter to the shareholders of the MD&A, which are part of that 10K report, which is all inclusive in the financial reporting. Then we might have additional information attached on top of that, which just puts it into a broader shell of all information useful for decision making. This basically helps you see the breakout of accounting information and how the basic key are the financial statements, needing with it the disclosures, then showing any changes in concepts or accounting guidelines. Then we get deeper into our MD&A and letters, just more fluff. Hate to say that. Shouldn't have said that. And then last and least, additional information. So these are all showing the detail of accounting information that useful decision makers can use. We are not going to get focused on the IASB and the FASB coming together. That's not a key that I really need to care about. For Chapter 2, you see what I really tried to highlight more on related to the assumptions and the concepts that I want you to focus on. What would be helpful for you guys is go in the classroom, and in Chapter 1 and Chapter 2, you see your solutions and your summaries. Look at the end of the chapters, go through the discussion questions,